A financial disaster deliberately ignored by mainstream media is unfolding in the American real estate market. While all eyes focus on ordinary homeowners' shrinking equity, the real tsunami is brewing on Wall Street institutional investors' balance sheets. The $2 trillion bet launched during the pandemic is now unraveling at a staggering pace. Latest Zillow data reveals we're witnessing the opening act of the most spectacular institutional investment disaster since the 2008 financial crisis. But this time is different. According to Zillow's report, 53% of properties nationwide are experiencing value declines, the highest proportion since April 2012. Dig into the ownership structure of these depreciating properties, and a disturbing truth emerges. 300,000 properties, from gold to garbage. Institutional investors who went on a buying spree during the 2021 to 2022 market peak are now holding what the industry universally recognizes as the hot potato of the century. Let's talk numbers, because these numbers are shocking enough. During the pandemic housing frenzy, institutional investors swallowed over 300,000 single-family homes. Invitation Homes, American Homes for Rent, Progress Residential, and hundreds of smaller funds launched an unprecedented acquisition wave. They weren't buying sporadically. They swept entire neighborhoods, typically paying 20 to 30% premiums above asking prices. Here's the critical inflection point. CoreLogic data shows that during the 2021 to 2022 peak, institutional investors paid an average of $420,000 per property. Those same properties, based on current Zillow valuations, are worth just $365,000 on average. That's an instant loss of $55,000 per property, and that's before accounting for carrying costs, property taxes, insurance, and maintenance. Simple math, 300,000 homes times $55,000 equals $16.5 billion in paper losses. But the story is far from over, and it's getting dramatically worse. The leverage game, when bets get 10x bigger. These institutional buyers didn't pay cash. Many used heavy leverage, mortgaging existing portfolios to finance this buying binge. When you're leveraged 70 to 80% and your underlying asset values drop 15%, you hit what Wall Street calls margin compression. In plain English, they're stuck between a rock and a hard place. What comes next is even scarier. Anyone with a pension or 401k should be terrified. The institutional money flooding into housing didn't just come from private equity firms. SEC filings show major pension funds, CalPERS, the Texas Teacher Retirement System, the Florida State Board of Administration, poured billions into residential real estate funds during the pandemic. Your retirement money bought the top. CalPERS alone allocated $2.4 billion to real estate funds actively buying single-family homes in 2021 to 2022. The Texas Teachers Fund invested $1.8 billion using similar strategies. These aren't small positions. They represent significant chunks of retirement assets for millions of Americans. And now, according to latest pension disclosure documents, these real estate allocations are showing negative returns for the first time since 2009. The Texas Teachers Fund recently reported real estate investment returns of minus 3.2%. with projections showing continued significant headwinds through 2026. Geographic concentration, the disaster amplifier. Here's where Zillow data becomes crucial. The areas where institutional investors concentrated their buying are exactly the regions seeing the steepest declines. Florida, Texas, Arizona, North Carolina, Georgia. These were institutional darlings during the pandemic. According to Zillow data, these have now become ground zero for collapsing property values. If you're finding value in this video, please take 2 seconds to like and subscribe. Every like, subscription, and share helps support this channel and motivates us to keep creating quality content. Thanks. Now let's continue. Take Florida as an example. Zillow reports Florida condo values are down 9.9% year over year, the biggest drop since 2009. But single-family homes, where institutional money concentrated, are down 4.9%. That number might not sound catastrophic until you realize institutional investors hold approximately 40,000 single-family homes in Florida alone. Metro-level bloodbath. The Tampa Bay meltdown. Institutional investors hold over 8,000 properties purchased in 2021 to 2022 at an average price of $385,000. Current Zillow valuation, $340,000. That's a $45,000 loss per property. Equity destruction in this metro alone reaches $360 million. Miami-Dade's worst story. Institutional buyers grabbed 12,000 properties at an average of $520,000. Today's Zillow valuation, $465,000. We're talking about $660 million in losses concentrated in a single county. Austin's absolute worst performance. Remember, this was the perfect storm of tech money meeting Wall Street real estate funds in an overpaying frenzy. Institutional investors bought 6,500 properties in the Austin metro at an average of $475,000. Current valuation, $380,000. That's a staggering $95,000 loss per property, $617 million in total equity destruction. American Homes for Rent, one of the biggest institutional players, stated in its latest earnings report that its Florida portfolio has experienced material headwinds in property valuations. Translation, they're hemorrhaging money. Multiple pressures, the perfect storm forms. But here's what should really worry you. These institutional investors aren't mom-and-pop landlords who can comfortably wait out the market. They have shareholders, debt obligations, and quarterly earnings targets. When asset values drop this rapidly, they're forced to make tough decisions. Pressure is building from multiple directions simultaneously. Insurance companies providing loans to these institutional buyers are now demanding additional collateral as property values decline. Wells Fargo recently sent notices to 3 major real estate funds requiring equity top-ups due to loan-to-value covenant violations. Bank of America quietly slashed credit lines by a combined $800 million for 2 institutional buyers. Meanwhile, rating agencies are starting to downgrade REITs heavily exposed to single-family homes. Moody's placed 4 major REITs on negative watch, citing deteriorating fundamentals in target markets. When credit ratings drop, borrowing costs rise, further squeezing already thin profit margins. Cracks appearing, strategic retreat begins. We're already seeing the first cracks in the foundation. Invitation Homes recently announced it's exploring strategic alternatives for portions of its portfolio. Industry insiders know this is code for, we need to sell before this gets worse. Progress Residential has quietly listed over 2,000 properties for sale in the past 6 months. American Homes for Rent has completely paused its acquisition program. Liquidity tsunami approaching. Now, here's the part that directly affects you as a potential homebuyer. When institutional investors start dumping properties at scale, they create what economists call a liquidity event. Suddenly, markets that were once inventory-starved get flooded with institutional-grade properties selling below purchase cost. According to Realtor.com data, we're already seeing this play out. Active listings nationwide are up 15% year-over-year, with inventory now at the highest level since 2019. But here's the key point. A large portion of this new inventory is coming from institutional sellers who bought at pandemic peaks. This explains why we're seeing such dramatic regional market differences. States like New York, where institutional buying was limited, are actually seeing prices up 3.9% year-over-year. But in institutional buying hotspots, the numbers tell a vastly different story. Texas, where institutional investors bought at the largest scale, now has 134,000 homes for sale, far above the long-term average. Tennessee, another institutional favorite, has inventory 50% higher than normal levels. These aren't coincidences. What's happening is institutional investors trying to quietly exit positions before the market realizes the full extent of their exposure. But there's a problem with this strategy. When everyone tries to sell at once, prices collapse. The derivatives web, a more dangerous time bomb than 2008. The story takes a darker turn here. Many institutional investors financed purchases using complex financial instruments, mortgage-backed securities, REITs, pension allocations. The web of financial exposure extends far beyond the real estate market itself. According to Federal Reserve data, total institutional exposure to residential real estate now exceeds $2 trillion. When you factor in all property-linked derivative investments, This is double the exposure from the 2008 crisis. But here's what makes this situation potentially more dangerous than 2008. Back then, the crisis was driven by bad mortgages to individual borrowers. This time, it's institutional investors, supposedly sophisticated players, who made the wrong bets. Unlike individual homeowners, institutional investors can't simply walk away from underwater properties. They have fiduciary duties, debt covenants, and regulatory requirements that force them to take action when asset values decline. NAR's spin versus reality's chasm. The National Association of Realtors is predictably trying to paint all this in a positive light. They're forecasting a 2026 market rebound, projecting double-digit sales growth and 4% price appreciation. But remember, these are the same people who've been saying there's no housing downturn for the past 3 years. More importantly, NAR represents real estate agents who profit from transaction volume. They have a vested interest in maintaining optimism regardless of what the data actually shows. Reality is starkly different. When you have $2 trillion in institutional money trapped in depreciating assets, you don't get a quick bounce back. You get a lengthy, unwinding process that could take years to fully play out. And we're only in the early stages of this unwinding. Key indicators to monitor in coming months. First, watch for more strategic portfolio adjustments from major institutional players. When companies like Blackstone's Invitation Homes start talking about optimizing geographic footprints, what they're really saying is they need to sell properties in declining markets. Second, track rent growth rates in heavily institutional markets. These companies bought properties expecting 8 to 10% annual rent increases. As property values fall, they'll push rents higher to maintain returns. This creates what economists call a rental displacement event, where rent growth actually accelerates even as home prices decline. Third, observe changes in institutional lending standards. Banks that finance these massive purchases are now deeply worried about their loan portfolios. Tightening lending standards for institutional buyers means less competition for individual homebuyers like you. Golden opportunity in the crisis. But here's where opportunity hides within the institutional crisis. As these sophisticated investors scramble to minimize losses, they'll create buying opportunities that haven't existed since 2012. Properties that sold for $450,000 at peak are now listed at $380,000. Based on current market dynamics, they'll likely ultimately close around $350,000. The key is timing your entry correctly. Based on our analysis of inventory trends and institutional selling patterns, the optimal buying window may open in spring 2026. That's when multiple factors converge: seasonal inventory increases, institutional selling pressure, and continued demand weakness, creating maximum negotiating power for individual buyers. But you need to be strategic about where you look. Institutional selling is concentrated in specific markets and price ranges. Florida Gulf Coast, Austin suburbs, Phoenix Outer Ring, Charlotte growth corridors. These are the areas where institutional money is most desperate to exit. Unique advantages of negotiating with institutional sellers. Here's what most buyers don't realize. Institutional sellers have different motivations than individual sellers. They have no emotional attachment to properties. They're not trying to time the market to maximize profit. They're trying to minimize losses and meet portfolio requirements. This creates negotiating dynamics that simply didn't exist when individual sellers dominated the market. Generational opportunity versus historic miscalculation. Bottom line, Wall Street made a $2 trillion bet that home prices would keep rising indefinitely. That bet is now failing spectacularly. According to Zillow data, we're only seeing the beginning of the institutional wealth destruction about to unfold. For savvy buyers who understand these market dynamics, the next 12 to 18 months represent a once-in-a-generation opportunity. But you need to act strategically, focus on the right markets, and understand you're essentially buying distressed assets from desperate institutional sellers. The real estate market isn't just cooling. It's experiencing an institutional liquidation event that could reshape the American real estate landscape for the next decade. Are you ready to capitalize on Wall Street's historic miscalculation? If you found this video interesting, please subscribe, share, and check out this video too.